Hi, it's Fed Day. So I just wanted to give you guys a little perspective of what I look at when I see that the Fed is releasing their minutes. Normally, it's pretty boring, but it's been pretty exciting if you are one of those, finance wonks that likes to look at numbers and policy and, just how that affects the overall economy and certainly, how I'm advising my clients. So we're going to start here. First of all, to share a screen here. And I'm just going to kind of show you some things that I noticed, right? So the Fed, they announced earlier today. So it was noon Central Time, 1 p.m. So Pacific time. So it was Eastern time. So they made the decision. So we just recently got it. The first thing that I saw was, our company, we have our capital markets secondary team that actually is the ones that set the rates for our company. So they just came out here and gave us the quick update, right? So the Fed, they raised the Fed funds rate to 75 basis points. So their range now, we're at 1.5 to 1.75. And the Fed funds rate, just so you know, the Fed funds rate is actually the rate that banks charge each other overnight. So if you look at a yield curve, right, a yield curve starts here at 0 days, right? And then you go out further out, and now you're getting to like a 30-year fixed mortgage, right? So you have 0 days or like a day all the way to 30 years, right? So you have various maturities along these levels. So you have a 10-year treasury, 20-year, 30-year, right? So that's a yield curve. So that's how that all works. So when they raise the Fed funds rate, the strategy of raising it so quickly is to tamp down inflation. And the way they do that is it's in our world, it's called demand destruction. So what they're trying to do is slow things down. So if people are spending a lot of money on credit cards, they are raising that overall APR because it's a short-term rate. So by raising the Fed funds rate, their goal is to slow down the economy so that supply can catch up, right? So they're purposely demand destruction. That's the goal, right? They're trying to slow down commercial, which are typically short-term loans, as well as credit cards, HELOCs, anything that's directly tied to short-term loans, car financing, all of those things. So that's what they did. So they raised the Fed funds rate by 75 basis points today. And as a result, we actually have gotten into this situation where mortgage rates are actually rallying a bit, right? So they were kind of flat. Now we're actually getting some pricing alerts to the upside. And you were like, how does that make sense? Like what, if the Fed raises rates by 75 basis points, how are mortgage rates going down? Well, it's because of the maturity, right? So it's that overall yield curve. So what's really affecting mortgage rates is inflation, right? So that's the number you got to watch. So I'm going to show you a little chart here, right? So we're going to pull this up here and we're going to look at the Fred graph, right? So this is inflation over since the 1960s. Right. So you can see based on this little graph here that we haven't been up in these higher levels for a long time. That's why you see the headlines that say 40 years. It's the highest inflation in 40 years because it is. Right. And if you look over here, this guy up here, that's where we were on Friday. So on June 10th, we had an announcement with the inflation where it came out at 8.6. Right. So really the inflation that we were watching last year where we saw it starting to creep up, right? So here's March, we're at 2.6, and then in April got to 4, and then June at 5. So what the Fed, they saw this and they weren't, it's not like they never saw it. They saw it, but their reaction, what they said was, this is temporary inflation. Right. So they saw this as a reaction to the economy opening back up and people going out and going on cruises and boats and planes and trains and all of that. And they said, oh, that's just natural. But what it was is it actually was the beginning stages of inflation. And it wasn't until really you got into January where we saw it come in. And I mean, that's the big one that, October 2021, where we actually saw the reading. It came out in January where inflation was at 6.2. Then it went to 7, then 7.5, then 7.9, then 8.3, then 8.1. So you saw mortgage rates, they shot up starting in January from 3.25 all the way up to 3.75 based on a 30-year fixed mortgage. based on Mortgage News Daily, which I follow because it gives me just kind of general ideas of where mortgage rates are. And you can actually see that in this graph over here. So let's just take a quick look. So let me pull that up. So you can see that, right? So all along this curve, right? So here we go. We're starting in, let me see if I can pull this down. So, you see it right here, starting in January, right? So we were at 3.3, boom, all the way up. And you see this thing right here. So this nice little plateau. So in mid-April, inflation, as I mentioned, it went from 8.3 to 8.1. So we were, so mortgages said, okay, looks like we found a little bit of a top. So for 2 months, April and May, you saw mortgage rates kind of steady, right? Even though the Fed had raised the Fed funds rate by 50 basis points during the first quarter. So that was back in March. So now what's happened is on Friday, this is where you saw that spike. Right. So right on 6.9, we went from 5.5 all the way up to 6.22. And that's because inflation surprised us to the upside and we came in at 8.6. Right. So in looking at this, okay, so we know that inflation is here. It's nasty. And the goal of the Fed is to tamp down that inflation. Right. So now what we do is, in addition to just looking at the Fed minutes. So, I mean, you could go to, CNBC or Bloomberg or whatever source you want. And, first of all, you have to click out all the ads, but you could get this information, right? So you can kind of get the general headlines. So it says Fed hikes its benchmark interest rate, the biggest increase since 1994, right? So you can look at the news headlines, but I don't know. I have an MBA in finance. I've been in personal finance for 14 years. I go beyond that, right? So I credit one of my old business partners. He actually showed me how to get to this stuff, but it's federalreserve.com, .gov. So federalreserve.gov, it'll actually show you where you have these recent minutes, right? So the Federal Reserve issues the actual statement. So I go in here and I click on that particular statement and I read it, right? So I'm here trying to advise my clients and I want not just what the particular news folks want me to say. I'm looking at this from the standpoint of how can I advise my clients, right? So I'm looking at it directly from the Fed, who is directly responsible for monitoring jobs as well as inflation. And the long-term goal is 2%, right? So they want to keep inflation at a nice, somewhat, pace where, it's not zero, but there's some growth, but it's not runaway inflation. That is a huge issue, right? So nobody wants $30 gallons of milk, right? So what they're saying here, so, they talk about the invasion of Ukraine, right, by Russia. We already know that. Their goal right here, so it says achieve maximum employment and inflation at a rate of 2% over the long run, right? So they said, okay, in support of that, we're going to raise it to 1.5 to 1 3/4. So that's 75 basis points. So that's where you actually see the headline part of it. And they say they're reducing the holdings of Treasury securities as well as mortgage-backed securities. So if you remember during COVID, or you may not even know, but during COVID, they actually were printing $60 billion a week in mortgage-backed securities and treasuries to stimulate the economy, because we were at one point where we had 50% unemployment because no one was working during COVID because everything was shut down. So now, not only have they stopped buying those securities, which increases the monetary supply, they're now selling them, right? So they're reducing their balance sheet, which is causing restrictions of the monetary supply, which is one of those factors that the Fed does to control interest rates. So that's one big thing. So they're raising the Fed funds rate and they're restricting the monetary supply at the same time. So they're doing these drastic measures because the Fed has a very difficult challenge ahead of them, right? So they need to make sure that they tamp down inflation, which, slow down inflation, but they also don't cause us to go into a severe recession, right? We don't want that, right? So they have to be very careful of what they're going to do. Now, the other big piece to this is let's take a look at this is the real wonky stuff, right? So I said, I'm kind of a wonk when it comes to this stuff. So I'm going to move my head there and we're going to go up here. So this is a summary of economic projections. So what happened is all the Fed presidents, whoever's on the Federal Open Market Committee, FOMC, all the meeting participants, they projected, so they sent in their projections. So the biggest numbers are right here, right? So what they're projecting here. So in March, they were projecting that GDP, we were going to grow 2.8% throughout this year. And actual is 1.7, right? So that's the real change in real GDP. So what's happening is we're now in stagflation, and stagflation is where you have high inflation and very little growth, right? That's not a good place to be, right? Because people want growth. You want increases in GDP. You don't want to have slowdown in growth and high inflation at the same time, because that's a disaster when it comes to the economy. So that's number one that I'm noticing. But they also get their projections for 2023 and 2024. So this is part of our crystal ball that we can look at this, right? The other part is the unemployment rate, right? So the projection was 3.5, but guess what? It's actually going up, right? So we expect that if companies are not operating at the same levels of profit, they're going to have layoffs, right? So that's just all part of economic cycles. So we could see the unemployment rate slowly increasing throughout these years, but nothing too crazy. This is just based on their projections, right? Now, the big one that I'm looking at this is inflation, right? So we're at 8.6, right? And in March, it was projected at 4.3. But the reality is we're at 8.6, but they're projecting at the lowest point this year, we're going to be at about 5.2. So what the Fed is telling us is they expect that what they're doing by raising the Fed funds rate, which shows it right here, right? So the Fed funds rate, they projected back in March that it would be at 1.9, right? So they projected that, okay, we're going to have a series of these raises. And at 1.9, that basically would be 4 raises of 50 basis points at a time, right? So 4 times 50, right? So that would be about 2%, right? So they would just kind of gradually, strong raises, but gradual. But now they're saying 3.4, which means that, okay, we have our medicine, we're at 1.5 to 1.75 right now. So now they expect it to go up an additional, what is that? So that's, 1.5, right? So they expect over the next, couple quarters that they're going to continue to raise it. And it might even be another 75 basis point raise. And, looking at that and then looking at the overall inflation, right? So this includes where you're looking at oil and gas, as well as food, right? So food and energy is the, all in, right? So that's the main number of inflation. And then you have core inflation that excludes food and energy. Again, they projected 4.3, and they're projecting by the end of this year it's going to be 5.2. So they are projecting that what they're doing with the economy in terms of inflation and raising the Fed funds rate, they think this is going to work and tamp down that inflation to get at that 5.2 level. So if we're at, let's say, 6.25 on a 30-year fixed mortgage today at 8.6%, then if they're expecting we're going to be a couple percentage points less than that, then interest rates might go down, right? So we might actually see mortgage rates go down this year. I certainly am not a prognosticator. I'm just following the numbers, right? So the next thing up is going to be what happens in July, right? So the Fed, they're going to be releasing, we're going to have those inflation numbers come out. And, keep in mind, we're at 8.6, we're at the top. And, if we're at 10, then I expect mortgage rates to go up, right? If we're now at 8.1, then now whatever the Fed has done with raising the Fed funds rate, now it's absorbed into the economy, and it looks like it might be working, right? So that's really what we're going to be watching. So what I'm advising my clients at this point, again, because I can't predict where things are going, I can just, this is the numbers from the Federal Open Market Committee, right? So these are the ones that study these numbers. This is their job. they have degrees in all of this, so they know a lot about this information. So they're going through their own projections, and they're saying that we think that what we're doing with all of the monetary policy that the Fed is implementing, that it's going to drive down inflation, which is great, which is awesome, which is what they need to do, right? So that's key. And then they're showing in 2023, they're projecting that it'll get back towards that level. So we're not going to be at 2% in the near term, but their longer term projections 2%, but at least we're not going to, they don't predict we're going to be in that, runaway inflation where it's 8%. So they're trying to slow down the economy on purpose so that supply can keep up, right? So that's really the main goal. And what I'm advising my clients is, okay, so if interest rates, so let's say a 30-year fixed, you're about to buy a house and you've been quoted 6.25%, and you're like, wait a second, 5 months ago I was at 3% on my pre-approval. I don't like that. What do I do? Well, you have two options, right? So what I'm advising my clients is you can go ahead and pay points. And I call this kind of the set it and forget it strategy, or the Ronco rotisserie, where you basically say, okay, I'm willing to pay points in this environment and get a lower rate, right? Because when you pay points, you actually go down that rate sheet and you get to lock in at a lower rate. But keep in mind, it's a sunk cost. So you don't get that money back. So if you were to sell that home in 3 years, or if you were to refinance, that money's gone, right? That money you pay up front. So keep that in mind. So that's really important. So you have the Ronco rotisserie, the set it and forget it, or you can go ahead and say, well, I'm going to go with what the Fed says, and I think interest rates are going to come down in the, I would say probably by the end of this year or maybe into next year. So I don't want to pay points. And as a result, I'm going to go and put as little points as possible. I may pay a little bit, maybe a quarter, maybe a half, but I don't want to put down a point or a point and a half, 2 points, or any of those things. So I'm just going to, the strategy there is I'm going to refi it and get it into a rate that I like, right? So at that point, what I do is make sure, you have to make your 6 mortgage payments, right? So you make your 6 mortgage payments. After your 6 mortgage payments, my clients, I'm setting them up on a rate alert where we're now going to set you up for a refi opportunity, and we're going to look at that, right? So we understand you don't like the rate where it is, but if you can afford it and you qualify and it's somewhat manageable, not ideal, but somewhat manageable, and you're still comfortable, with that payment, then okay, we move forward. But the strategy is to try to get you either to refi, or you pay as much points as you possibly can. And keep in mind, you can't buy like 5 points, right? So there's QM rules, qualified mortgage rules, high price loans, where you can only pay 3% in origination fees, right? So that includes your lender fees and escrow and a couple other fees that are baked in there, including lock extension fees and all of those. So you can't exceed 3% overall, based on 3% of the loan amount. So keep that in mind. But hopefully this helps. And, I'm going to be kind of, following this and doing a little more videos of this, just so that people understand what we're looking at and how I view it, right? So, typical American, they're going to look at the CNBC headlines and they'll say, okay, it says they were raised at 75 basis points. I don't know what that means. And, I think the Fed's raising mortgage rates, but yet mortgage rates are going down today. I don't get it. I'm going to bow out, right? Again, the Fed doesn't raise mortgage rates. They're raising the Fed funds rate, which is at 0 days. And the goal is to tamp down inflation. So if you have any questions, I'm around. Feel free to reach out at any time. Thanks for watching.